Hello, welcome to Any Answers Answered for September 2017. Hopefully everybody had a good summer, well rested I hope, but still asking questions, still asking some great questions on accountingWEB, and Tim and I have picked out a couple to have a look at. The first one, Tim, is from, I have no idea, is that Toan4, Toan4, whoever. Sense check for use of intercompany loans. Now, I'm not convinced this question is even about loans, but we can have a look at it. A set of accounts prepared by my accountant for two companies, A and B, for the sake of discussion, within which I am both director and only shareholder. He has proposed to take advantage of some losses in company B to reduce the tax exposure in company A by using an intercompany charge/loan. However, for the year in question, there was no actual transfer of funds between the two companies. Is this appropriate, a legal way to proceed? I don't think we're talking about loans at all, are we? We're talking about management charges.
Yes, the implication of the question seemed to be whether you can establish an intercompany loan without any money changing hands and just by double entry. But you're right, it's not about that at all. Of course, you can do that. And the first answer to that query was from John Grog Ganja. There's no need for cash to change hands. P.S. You should have more faith in your accountant. But actually, looking at it, what's it all about? It's about management charges. What the accountant is trying to do is get the loss in A Limited removed by A Limited charging B Limited a management fee, comes in as income in A Limited, extinguishes the loss, and no corporation tax in A Limited because it's covered by the loss. B Limited then gets a corporation tax deduction for that management charge. No money changes hands, and so the double entry in A Limited will be credit income with that management charge, debit debtors, and corresponding double entry in B Limited. And then it boils down to the age-old question, can you do this? Answer?
If it's wholly and exclusively out of thought.
Well, that's the point.
But
The question is, will B Limited get corporation tax relief? It can debit its profit and loss account with that management charge until it's blue in the face, but the revenue looking at it will say that wasn't incurred wholly and exclusively for the purpose of the company's trade, and therefore disallow the corporation tax deduction in B Limited. And so the basic thrust of this, and that in fact is what Paul Wakefield 1 says in his reply, agree with John, but to expand, any cross-charge should be commercially justifiable. And also mentions VAT, which I don't. So, you know, that is the answer to that. One final point I would add to that is that maybe the accountant who's advising this, who shouldn't be advising that anyway, I think, should have thought some time ago about suggesting that they have a little group where the shareholder director has a holding company in which he's the sole director shareholder, and that holding company owns the shares of A Limited and the shares of B Limited. Because of course then you get group relief and the problem wouldn't arise, because you would then be able to transfer the losses assuming the conditions are met.
And not only would there be group relief with the new rules coming in from April this year, easier to carry forward that loss and then group relief at all sorts of things. Of course, the other option here is to leave it for a year and then hopefully the profits in the loss-making company will eat up that loss anyway. So various ways around it. The answer is technically possible, but we're not really sure you would want to do it. Question 2 comes from MEIN, and it's to do with trivial benefits yet again. A very simple question. We thought, after are employee gifts and director gift up to the maximum of £300 deductible for corporation tax if they are not entertaining, e.g. clothes vouchers, for example? Any help would be great, please. Now, the thing I want to highlight here is that we have focused so much on the benefits this brings as far as the employee is concerned, and the fact that there is no tax to worry about as far as they're concerned. I'll be honest with you, I'd taken my eye off the corporation tax completely.
Well, and you'll not be alone on that, I'm sure. We sit here in September 2017, the season of mists and mellow fruitfulness, and it's not that long to go until Christmas. So employee benefits and trivial benefits and so on and so forth. Many viewers and others will remember us talking last year about John Lewis vouchers and the like. Are these corporation tax deductible? If your company has, let's say, as ours do, a 31st December year end, then will have provided these benefits last December, let's say. Trivial benefits under the rules that came in last year could be for director shareholders up to 300 quid, for employees no upper limit but no more than 50 quid per throw, and various other conditions to be met. So we then didn't put those on P11Ds that were filed earlier this summer. But now we're thinking about the corporation tax. If we've not already filed the corporation tax return, I think we have recently for our companies, is there an add back required? Well, the basic corporation tax rules have to apply. Is the expense incurred wholly and exclusively for the purpose of the trade? Ordinarily, any sort of employee benefit and director fees will be treated as incurred wholly and exclusively and therefore corporation tax deductible. But the points to watch out for are, first, if it's disallowable under some other part of the corporation tax code. Now, what disallowables are there? Business entertaining is disallowable. What about staff entertaining?
Well, we normally cling to the £150 rule and things like that,
For,
don't we?
what £150?
Well, the idea of a Christmas party.
No,
or
you're talking
like
about benefits again. I'm talking about corporation tax, and this is where we've got to be very disciplined. So for corporation tax, what's disallowable? Business entertaining? Is staff entertaining allowed or disallowed?
Well, I think we're back to the wholly and exclusively rule,
Well, it's
aren't we?
normally allowed.
That's all.
Normally allowed, so there shouldn't be a problem if, what we're talking about here, employee gifts and directors' gifts, are they allowable if they are not entertaining, is what the question says, e.g. clothes vouchers, for example. To which I would say, yes, they are allowable. If it's entertaining, you need to be a little bit careful to make sure that you don't breach the rules and the dividing line between staff entertaining and business entertaining.
But also you need to watch out for the fact that whilst there is no specific refusal of deduction for staff entertaining, we still have to meet this wholly and exclusively rule. And therefore we could have problems if the only person who works in the business, a sole director shareholder of a company, starts taking himself out for tea, then that has to be questionable as to whether it is incurred wholly and exclusively, I would suggest.
I'm not sure that it's any more questionable for a director than for an ordinary employee, although for the ordinary employee, I think the revenue would accept that the company's only to do this to foster good employee relations and so on, whereas if you're a director shareholder, it makes no difference. So I think I might want to stick to John Lewis vouchers rather than Costa Coffee for the directors, but for ordinary employees, it probably doesn't matter. And
so the answer as far as the question is concerned is yes, you do get corporation tax relief as long as it's not entertaining. If it is entertaining, then do just watch out for the age-old rules of tax, which we're very familiar with, wholly and exclusively and all that sort of thing. Do continue to post your questions on Any Answers, and we look forward to answering possibly your question next month. But for this time, bye-bye.